Hi there. In this video, I'm going to be looking at influences on financial management, more specifically looking at financial institutions. Now, the very first financial institution is also the most common one, the most widely used one, and that's banks. Okay. Now, how do banks involve themselves in terms of being an influence on financial management, and how do they help a company? Well, firstly, banks obtain their money really from the savings of individuals and other businesses, any deposits that are made into the bank. Okay, now that means that there's a big pool of money in the bank. Now, a business might come along with a very good business plan and say, I need a loan. Okay, now the bank will use the money from the deposits of individuals and other businesses and, whatever sources of deposits they have, and loan the money to the business. Okay, and in exchange, the business will then pay interest to the bank. Okay, and then that's what the business uses, among other things, to make their own profit. And then a bit of the money they got from the interest from the bank will then go to paying the interest on the savings of the individual. Now, there's always going to be a bit of a discrepancy there. The business might pay maybe $1,000, $2,000 worth of the loan back. A lot of that might be interest. An individual might only get 50 cents in their bank account as interest. Okay, however, that's the bank rewarding you for putting money into the bank, which then they use to invest in, businesses. Okay, in a nutshell, that's how businesses would operate. Okay. Another financial institution that could be used are investment banks. Okay, now they deal mainly with making investments. Okay, they trade in money. Okay, in cash, currencies, securities. Okay, stocks and other securities, and financial futures. Okay, now you will look at financial futures a bit later on in strategies of financial management, namely the global strategies. Investment banks also arrange long-term finance for companies to be able to expand. They provide the working capital, so the liquid funds, the short-term funds that a business might need to pay their short-term debts. And they also give advice on mergers and takeovers. Okay, and then they might also be able to provide that finance for the expansion. So they'll give you advice on how to merge or acquire another business, and then they could help you with the finance there as well. Okay. Another financial institution are finance and life insurance companies. Okay, now, these are non-bank financial intermediaries, and they specialize in smaller commercial finance. Okay, we're not talking very large sums of money here. These are smaller commercial finance. Okay, now they're regulated by APRA, APRA, the Australian Prudential Regulation Authority. Okay, now I'm going to break up finance and life insurance companies. Firstly, finance companies, they provide loans to businesses and individuals, okay, to pursue business ventures or non-business ventures even. Some might also do factoring, okay, which we looked at as a short-term external form of debt, okay, and they also raise capital through debentures, which again we looked at in the sources of finance. And finally, they have the security of the priority over the firm's assets in the event of liquidation. So if the firm ceases to operate and they undergo liquidation, finance companies basically, if you want to look at it in very slang terms, they've got first dibs on the company's assets to recoup some of their losses. And then insurance companies, they provide loans to the corporate sector, to businesses, through receipts of insurance premiums. Okay, this operates just like banks. Okay, people pay insurance. Okay, might be $1,000, might be a couple of $100, but whatever it may be, all that money gets pulled together by the insurance company, and then they also in other ways for them to make money is to use your insurance premiums to provide loans to businesses as well. We've also got superannuation funds. Now, superannuation funds as well operate just like banks, just like the life insurance agencies. Superannuation is the money put aside by your employer for your retirement. Okay? Now, superannuation funds, you really can't touch it until the retirement age. Okay? Now, because you've got, if you start working, let's say at 15 or 16 even younger, 14, 9 months, and you work until 65. Okay, you've got many, many, many years of accruing this money. Now, by the time you retire, you'd hope that there's a lot of money in there to be able to live a comfortable life. Buy a caravan, buy a boat, buy a property somewhere to enjoy your retirement. So what superannuation funds do is part of their methods of increasing your super is by investing in things like shares, currency, etc. However, it is a gamble. Obviously, you might actually retire with little to nothing because the investments that the superannuation fund made didn't pay off. Okay. However, one thing that superannuation funds also do is they also provide loans to businesses. They invest in other businesses, okay, with the hope of making money to then be able to give back to you for your retirement. Okay, so that's another way they operate. And one of the other financial institutions that could be useful here are unit trusts, also known as mutual funds. Okay. Now they take funds from a large number of small investors and invest them for them. Okay. Again, very similar to how the other forms here work. Okay. The mutual fund will take investments from individual people. These three people here might put in $1,000 each. That mutual fund will take that $3,000. They again will invest in shares. They invest in currency. They invest in gold, in oil, in whatever that you might want to invest in. Okay, run by a mutual fund manager, so someone that knows what they're doing. They can give you advice. And again, they will invest in businesses. They'll provide money for businesses who in turn give money back to the mutual fund, which then they pass on to you as a profit. Okay, now again, this doesn't necessarily mean it will give you a return. Okay, this again is a bit of a gamble. Okay, however, this is another way that businesses can access funds. Okay, and finally, we've got the Australian Securities Exchange, the ASX, which is something we've already looked at in terms of external equity. Okay, and this offers products, services, includes shares, futures, warrants, securities. We will look at those in a lot more detail when we look at a global financial management in the strategy section. Okay, and even within the ASX, there's two types of markets. Okay, there's the primary market. So this is the new issue of debt instruments by the borrower of funds. So never released before shares, brand new shares basically. And that's one way it operates. So the ASX allows companies to float, become public companies, and offer brand new shares for the first time. But the ASX also operates as a secondary market. Okay, and what that means is it then also operates with the purchase and sale of existing securities. So once those new shares have entered the marketplace, then when they start being bought and sold every day by other people, that's when it becomes known as the secondary market. They're no longer new shares; they're now just trading hands. So they're secondary. Okay. The next video looks at influence of government and global market influences. It is the last video in the influences on financial management. However, I hope this video on financial institutions has been valuable. Thank you.